Mike Zahrt here with Taylor Gast on another Paycheck Protection Program update for you. Taylor and I have been talking to small business owners and employers for weeks now, and most of them remind me of Charlie Brown trying to kick a football, right? Because every time they think they've got it figured out, we get new legislation, we get new regulations, and Lucy just pulls that thing out from under them. So if you've been fortunate enough to avoid that sensation, you might just experience it after this video. You've probably seen in the headlines the legislation that was just passed, the Paycheck Protection Program Flexibility Act. Some more changes coming down the pike here. So we're going to do a little different format for you today. The new legislation is only 10 pages, doesn't justify a webinar. So we've got this little 15, 20-minute video for you. Watch it on your lunch. We'll have our contact information at the end. So when you get done with this thing, if you have any questions, feel free to call or email me or Taylor. We're happy to chat about this stuff. It's always a moving target. More flexibility here, more proactive planning opportunities too that we're going to discuss here in a minute. So I guess, Taylor, let's hit the highlight. This new legislation extends the time we have to spend our PPP proceeds. What's that about?
Yeah, right. Absolutely. It's this is probably, I think there are two top line changes, right? And I think one of the big ones really stems from concerns that all sorts of borrowers have had that, hey, we're basically shut down, or we're under the stay home order. We can't really operate. What are we going to do other than pay our employees to sit at home? And the idea here is that we'll give some additional time. And so now, instead of previously we had 8 weeks to spend loan proceeds and claim forgiveness for those expenses 8 weeks after the loan was initially deposited. Now we have 24 weeks. So this is a pretty significant extension. I'll note that it's the lesser of 24 weeks, or if we arrive at December 31st, the end of this year, then that's our stop date. But that wouldn't apply unless we end up with a loan in June or July, excuse me. So the big kind of a big push out on this one. You have 24 weeks to spend your loan proceeds. One related item that I just mentioned also is that to the extent that we don't have, to the extent that some of our loan proceeds stay alone and aren't forgiven, we have now 5 years to repay that as well instead of 2 years. So some very borrower friendly updates on this part.
Yeah, absolutely. Very helpful. It's interesting if you're at the end of the 8-week period. I've got a few clients where I think this week is pretty much it. They're at the end of their covered period, and if you find yourself in that boat and you've been planning for full loan forgiveness this whole time, you've probably already spent most of the money. So they have addressed those folks. If you want to retain your 8-week period, you can keep your 8-week period. I wouldn't be surprised if people in that position end up doing that, and the money's pretty much gone. Interesting about all these deferral periods. I think they're going to have to update the regulations they issued a couple weeks ago, because they're just flat out inconsistent now. So it'll be curious to see how they reconcile that and how fast they do it. So yeah, I mean, if there's a theme to this regulation, it's flexibility and it's extending time to do things. Another one of these things that got extended is that June 30 safe harbor. We previously had this June 30th date, bring everybody back to work. That got pushed out now too. So what's that about? What's the new deadline? What do people need to know?
Yeah, so previously, if you guys were watching us on our last webinar, we were talking about some fleshed out details on this safe harbor that's out there, and was really a helpful piece of the puzzle for a lot of our borrower clients. And the rule was basically that you had until June 30th of this year to rehire any employees that you've laid off and restore their wages. And if we did that and restored both full-time equivalent levels and wage levels to kind of pre-COVID levels, then we would not have a reduction in our loan forgiveness. And it's a pretty helpful rule. And now it's become generally more helpful, because instead of June 30th, we actually have until the end of this year to make that happen. So we have all sorts of businesses who we've been talking with who are saying, well, the ramp up here it's happening, but we might not be back by full strength by June 30th. How's this going to work? And, we've really pushed, this back and thrown out a lot of flexibility by pushing this to the end of the year. And now I think we want to note that there's some question as to how some of this is going to work. And, Mike, I know we've been discussing the idea that it looks like based on this legislation, the borrower can decide when to, submit their loan forgiveness application and sort of judge this as a snapshot on the date of the application or roughly thereabouts. And that, let's say it's August 30th and we've restored our FTE and wage levels by then. The new net legislation doesn't totally address what we're going to do if, for instance, maybe in September after applying in August, we have some sort of reduction because we just had to let somebody go or the business has hit a rough patch that we didn't anticipate. But right now we expect, and maybe you can throw some color in on this, Mike, we expect that you can apply sort of in between now and December 31st and gain the benefit of that sort of interim date. But this is definitely a little bit of a let's, keep our eyes on updates as they come out, right?
Yeah. This to me is one of the areas we need the most guidance on. It's this timing issue of, when can you apply for loan forgiveness? And there's all sorts of interesting hypotheticals now, because I think for most people, they had their loan and they were pretty sure that their covered period was going to run out somewhere around June 30th. So the snapshot date around then kind of made sense from a timing perspective. And now we've got this 12/31 date. It's like, what do I do for my clients who their covered period runs out this week and they were going to rely on the June 30th safe harbor? Can they now wait till July 30th, August 30th? Can they wait all the way until the end of the year before they submit their forgiveness application? Maybe. We just don't have any guidance. The way the statute is written, it describes the safe harbor as, returning to prior levels no later than 12/31/2020. So to me, that suggests that you essentially have this open period of time until the end of the year, to where if you want to wait to apply for forgiveness to get your FTE levels back up and your wage levels back up, you can do that, which is a huge planning tool, right? If you are, a restaurant and you're at 50% capacity, you don't need 100% of your staff, but if you think you might get there by August, this is a great rule for you. So that's something we're just going to need more guidance on, something to watch in the regulations. The nice part is, the way they change these deferral rules. If you've got somebody whose 8-week period runs out and they're not at the FTE level and they want to wait to apply, the old rule is you can only defer payments for 6 months. So even under the old rules, your 8 weeks runs out today, you wait until June 30th and you're a month in, and then the bank has 60 days to process your forgiveness application. Now you're 3 months in, and the SBA has 90 days to make their decision. Well, now you're 6 months in, and maybe you don't have forgiveness yet, and you got to start making a payment. And that, I think people recognize, that makes no sense. So we've got this new rule now that essentially says your payments are deferred until your forgiveness application is processed. It completely removes this possibility that you're going to have to make a payment even though you qualify for full forgiveness. So, that helps people, especially the people who are really cash strapped. You're not going to have that hit to cash flow to make a payment on a loan that should really be a grant. So we've got some rule changes that help, but we need some clarification, I think, is the highlight there, especially on the timing piece of all this. And, that kind of goes into these new FTE, I guess we're going to call them new safe harbors, right? So we had a safe harbor of June 30th, and then the old rules gave us more exceptions that are still in effect for people who voluntarily terminated employment, terminated for cause, asked for reduction of hours, people who have rejected rehire offers on same hours, same wages. And now we've got more rules to keep track of, which is borrower friendly, but it's more to keep track of. So can you give us kind of the 10,000 foot view of the additional FTE safe harbors we've got?
Yeah, absolutely. So, like Mike said, the baseline rule is that unless we have an exception that applies, if let's say we have reductions in our FTE count, we're going to have a sort of a proportional reduction to our loan forgiveness. unless one of those exceptions applies, like, we had to fire somebody for cause, or somebody voluntarily, terminates, or something along those lines. We've talked about those exceptions, and whether, safe harbor exception, whatever we're calling these, we've got two more now. The first one applies if, the borrower can document, and document is an important, I think, kind of concept here. Let's think about that. But we can document an inability to, one, rehire individuals who were employed on February 15th of this year, and two, replace those employees with similarly qualified employees before the end of this year, 12/31. So we did our best. We tried to rehire them. We put the effort out into this, and we just couldn't make it happen. And we can document this. So I think there's an open question, and if there's anything that's ripe for a frequently asked question or an update, and who knows whether they'll give us this, but it's what's that documentation really look like on, we went out and we did our best. Do we need to show a job posting, which makes sense for some types of employees, but not others? What is it? So that's the first one. That documentation idea kind of carries over into our second exception as well. The second exception applies if the borrower can document an inability to return to its level of business activity before February 15th due to compliance with requirements established by the Secretary of Health or Human Services, the Director of the CDC, or the Occupational Safety and Health Administration during the period beginning on March 21st and ending by the end of this year, December 31st. And that, that guidance or order has to be related to standards for sanitation, social distancing, or any other worker or customer safety related to COVID-19. So basically, basic idea here is, we have some new public health guidance that's out there. We want to make sure that it's, the official guidance. So, the CDC, OSHA, et cetera. And if we have that guidance that's out there and it's basically prevented us from returning to normal business levels, let's say that's because now we're a restaurant and we now have to have 50% capacity for our sit-down business, and that's prevented us from getting back up to normal business levels. And for that reason, we have, let's say, a lower FTE count because we just can't support, that level of employment. This gives us an out. This gives us a justifiable excuse to say, we're accepted from, a forgiveness reduction. And there's all sorts of other scenarios, right, Mike, where, might see this as a really useful planning opportunity or useful way to avoid forgiveness reductions.
Right. Yeah. I mean, the new legislation says that you have to act in good faith and document this stuff. And I think when most people hear good faith, they probably think of it the way they should. And that's, don't be fraudulent about it. Be truthful. Don't fabricate a situation to take advantage of a safe harbor. When lawyers hear good faith, we think paper trail. And it's hugely important to have a paper trail on this stuff, right? Because on the off chance that your loan does get picked for audit, you don't want the SBA guy coming around and saying, well, I see that you took an exception due to, CDC cleaning requirements or social distancing requirements. And you don't want to just tell them, oh yeah, well, I got these 2 mills that are close together and I can come show them to you, right? I mean, you don't want to do that. You want to have your memo to the file that if I'm running the tool and die shop and I got 2 mills that are within 6 feet of each other and I can only run one, that might be fine because I don't have the capacity to run 2 anyway. So I've already had this guy laid off, but now I have a perfectly valid excuse in this new legislation to not take the hit on the FTE count too. So this might be a proactive planning situation where, you've got something where just the demands of the economy have you running at a diminished capacity. And now, I'm not saying be fraudulent here, but think creatively, think broadly about, is this a situation where I can rely on either of these 2 safe harbors to avoid a reduction in forgiveness. Another one I can think of, I think this will be huge for people, is in the healthcare industry, particularly dentists and opticians and whatnot. You look at the new CDC cleaning requirements, and it's pretty onerous, especially for this elective medical procedure stuff. And you're going to have just fewer people. Dentists are going to have fewer hygienists because you're going to be paying people to clean the exam rooms instead of doing the cleanings. And if that's you don't have to. I mean, if you want to pay your hygienist their regular rate to clean a room, that's fine. But if you want to pay somebody minimum wage, or just have just the one hygienist handle it, however you want to do it, the name of the game here is you've got the flexibility now to where if you've got government guidance, you don't have to take the hit on the FTE reduction. And I think that's the key here. It's either government regulations or guidance. So it doesn't have to be a thou shalt do this in a regulation. It can just be, hey, the CDC thinks this is best practice. That's what we're going to do. And it results in me having fewer FTEs. And that's fine. You can not take the hit on that. And mathematically, that might be a good thing to do too, right? Because if you're employing less people, you're spending less money on payroll costs. And now we have a longer period of time to use those payroll costs. You can stretch the proceeds of your PPP loan in a manner that makes sense for ramping your business back up. And you can do that now in a manner that's not going to hurt you on the forgiveness rules. So I think that one's huge. I think people should take a close look at that regardless of their industry. There are a few that's going to help more than others. Okay, moving on to the next one. This 75% test. They just keep changing this thing. It's now the 60% test. So what's that about?
Yep. So previously, we had to spend at least 75% of our loan proceeds on payroll costs in order to obtain kind of maximum forgiveness. So let's say our goal is to have the entire loan forgiven. 75% of the loan proceeds must be spent on payroll costs, which, again, it's a pretty broad term, that is more than our just, wages and salaries. But nonetheless, we had plenty of businesses out there that were, feeling a little, bound by that rule. And so, lawmakers here have reduced that 75% requirement to 60. So now you must spend 60% of your PPP loan on payroll costs, and up to 40% can be spent on non-payroll costs, your rent obligation, your mortgage interest, some of the other items, utilities, those items that we've previously discussed. Now, there are a couple nuances here, and I think the big one is a little bit of a wait and see here. And this one, talk about swinging back and forth. When this rule first came out and we were looking at it under the CARES Act, we were throwing some very significant caution out as to how we view the 75% rule for forgiveness purposes, because there was at least an argument that it was kind of a cliff. It was, if you don't hit that 75%, you might just fall off a cliff and have no forgiveness. And everybody kind of thought that seemed a little harsh and weird, but nonetheless, without too much guidance to go on, we were sort of throwing out that caution flag. And then we got the update that this looks a lot more friendly and great. It's actually not a cliff, and we're just going to be reduced in our forgiveness amount so that, we reach that 75% threshold based on the reduced forgiveness. And now they've thrown out this new legislation, and it appears to potentially at least swing us back in the other direction, and it looks more like a cliff all of a sudden. Now, we also at the same time have some pretty just clear statements from some of the principal lawmakers and drafters of this legislation that says we really didn't intend for this to be a cliff at all. It shouldn't be a cliff. We don't want it to be a cliff, but they're also acknowledging that it reads like it might be a cliff, and we might have just a total forgiveness reduction if we don't hit 60%. So careful is the advice right now, because on the one hand, it sounds like it might not be a cliff, and it sounds like that might not be the intent, but we all sort of see the language, and the language looks like it's a cliff. So without more guidance, let's just be real careful about making sure we get to 60. And frankly, for a lot of our clients who've been planning on 75. I think 60 should be, something that we can meet and should feel like a nice cushion now, but
Yeah.
something to keep in mind.
Yeah. Yeah. And they're going to have to modify the application now too, right? So that's out. And if
Yeah.
you've been kind of working on your draft of that, fine. Keep in mind, they're going to change that. They're going to have to, because the 75% reduction first appeared in that application. It was just purely a mathematical formula where you took your payroll costs divided by 0.75. And now that's one of your potential maximum forgiveness amounts. And that really solidified for people that this isn't a cliff. It just caps our non-payroll costs at 25%. So the easy fix here is change the application and make it divide by 0.6 instead of divide by 0.75. It's actually going to have, the mathematical effect of increasing your forgiveness amount. So that's nice. But yeah, I mean, talk about, well, you get a second bite at the apple and you still create that ambiguity. It's not great. But yeah, proceed with caution there. One other just note I'll make real quick on that is to keep in mind that we do have this paid or incurred standard now that came out in the forgiveness regulations, making the dangerous assumption that that stays in place. That also gives you some flexibility now too to pull in more payroll costs and non-payroll costs, right? So you can count stuff that you paid or incurred during the covered period. And our covered period is 24 weeks now. So, I mean, you've got, it's a huge period, but stuff on the front end is probably what I would look at. If you've got stuff that, rent obligations, utilities that you incurred before the start of your covered period, but you cut the check during your covered period, you can count those. So make sure you're pulling those in. Stuff on the back end isn't going to be as pertinent anymore, because I think most people are going to burn this up and apply before December 31st. I guess conceptually, you could get all the way to that point, incur costs all the way until December 31, and include those, even though you're not cutting the check until January 1. I don't see many people that are going to fall into that bucket, but it is possible. Okay, in the interest of keeping this concise, I think the last highlight we've got to hit is the ability to defer payroll taxes. Can you give us the quick summary of that?
Yeah, absolutely. So previously, when the CARES Act came out, there was a provision under it that allowed businesses that do not receive PPP forgiveness, not just the loan, but all the way to forgiveness, those businesses could defer 50% of the employer's share of 2020 Social Security tax until 2021, and the other 50% until 2022. And we had plenty of borrowers who are sort of able to take advantage of this on an interim basis. But knowing that once we sort of have that forgiveness determination, it wasn't going to continue to fly. Now the new legislation here provides this to everybody, and so it's just a baseline allowance. So that's fairly helpful. It's something that kind of no reason not to take advantage of, unless not something you're seeing much of a benefit for, but it's there. So benefit that we should take a look at if we haven't already.
Yeah. Originally it was kind of the consolation prize, and we had been previously telling people, who were saying, I'll just pay people to stay home. It's free PPP money, and we kind of had to caution them that look, it's not truly free money, because one of the things that's not includable in payroll costs, right, is the employer portion of payroll taxes. So you're still going to be paying those, even though you're paying people to stay home. So most of it's free, but not all of it's free. That's still true, but you can defer it now. So it's very helpful. We're always trying to defer tax liabilities. So absolutely a helpful planning opportunity that more people have now. If you do your books yourself, maybe it comes out in a QuickBooks update, maybe it doesn't. If you have a CPA, absolutely be talking to them about that. Especially, it being the month of June now, you're probably going to have a filing at the end of the month. Just make sure you're staying on top of that. So that's it. That's our 5-point sermon on the highlights. Obviously, there's going to be more stuff to come out of this. There's going to have to be updated regulations. There's going to have to be an updated application. We'll be back with more updates as we receive them. But in the meantime, if this changes your planning, or if you think that you might fit these new FTE safe harbors and want to talk about, hey, how should I be documenting this? Do I even qualify for it? What guidance is available out there that maybe I'm not aware of, that I should be aware of, that would create a proactive planning opportunity for me? Those are all instances where we can help. We've got a whole bunch of folks that are experts in those areas too. So definitely a group effort on our end, a group effort with you too, to make sure that we are taking advantage of all of this new flexibility that's out there. So with that, I think we'll conclude this video. We'll show our contact information here in a minute, but thank you for taking the time to listen, and feel free to reach out with any questions.
Thanks, everyone.